Good morning from London. I'm Guy Johnson, joined by Kriti Gupta, who's in Paris today.
Guy, I've got the best assignment. We're covering the private equity industry out of Paris, not to mention all the politics out of the French capital.
Okay, we're an hour away from the opening trade. Let's talk about the headlines that you need to know this morning. Stocks are stabilizing after heavy selling last week. Oil is also bouncing. Investors, though, facing a busy week. We've got the ECB meeting, we've got a presidential debate, we've got CPI out of the States, all of that to worry about. Whatever it takes, Mario Draghi will this morning deliver his long-awaited report on what Europe must do to regain its competitiveness. The plan will shape the agenda for Ursula von der Leyen's new commission. And donnez-moi plus de temps. Paris asked Brussels for more time to submit its budget proposal as Prime Minister Michel Barnier races to get to grips with France's 2025 finance bill.
In the meantime, a quick check on these markets here. You are seeing futures indicated higher when you look at the Eurostoxx 50 futures and the FTSE 100. But to me, Guy, it's all about the currencies. You're seeing weakness in euro dollar, weakness in cable. A lot of this coming off of the strength that you're seeing in the U.S. dollar. A really interesting reaction given the payrolls number we saw on Friday. The countdown to the opening trade starts right now.
I believe that the balance of risk has shifted toward the employment side of our dual mandate, and that monetary policy needs to adjust accordingly. The current batch of data no longer requires patience. It requires action.
Chris Waller, speaking after the payroll number on Friday, the consensus from what he said was that we probably can do 25. We don't need to do 50. And the risk assets really did not like that, which is interesting, a really interesting reaction. Kriti was talking about what was happening with the dollar, what is happening with the dollar. What we seem to be having here is a situation where 25 we thought was going to signal a soft landing, that the Fed is comfortable with what is happening. But the markets now seems to be worried that the Fed is behind the curve, certainly risk assets. And as a result of which, if the Fed doesn't deliver 50, that is perceived as being a negative. Now, this is really interesting because 25 is now priced for September. Beyond that, it's a coin toss as to whether or not we get 50. So is 50 now good news for risk assets and 25 bad news for risk assets? That, I think, is the question that a lot of investors sitting down at their desk this morning, Kriti, will be asking themselves.
Yeah, it's a good point. And you've been asking our guests this quite a bit. Does 50 actually spook the markets to the same extent? And the fact that we're seeing a flip makes me question a little bit about whether the narrative is more about what the economy is doing or more about the credibility of the Federal Reserve. Guy, we've seen this play out before in this idea that is the Fed late to the game, and was a 50 basis point cut the solution to that, given so many people have been saying they should have already been cutting to already stem some of the weakness that we're seeing in the economy. The flip side of that argument is, Is this weakness in the economy, or is this simply normalization?
Yeah, that I think is the question that I think a lot of people are trying to understand at the moment. But the idea was that we were in a soft landing scenario. If the Fed needs to do 50, are we still in a soft landing scenario? Is the soft landing still a base case? Now, in many ways, Kriti, the data would certainly suggest that we are. Looking at what we saw out of the numbers Friday, you're seeing wages actually looking fairly healthy. You've actually got the employment story getting better. That seems to suggest that maybe we are still in a soft landing, but the market maybe no longer believes that we are.
I mean, we love to say that there is this economic resilience coming out of the States, but compare it to something you're seeing in other parts of the world, arguably right here in Europe, and it's almost the same narrative. Guy, the fact that we're talking about the same thing on both sides of the Atlantic, I think is interesting. It is no longer a question about inflation, which I think was driving the narrative the last 2 or 3 years, is now a question of sustainability, and that's where Europe, for example, isn't doing as well as the United States. It brings me quite smoothly as well to a major report we're watching for today. This is, of course, Mario Draghi, the major technocrat, the former premier or prime minister of Italy, speaking about a report on competitiveness. No leaks yet. A really fascinating thing to find out. Where do the potential 900 million euros he's talking about in terms of investment actually come from?
The question is he too late? Is this problem something that we should have tackled a while ago? Yes is the obvious answer. But Europe seems to have moved on politically quite quickly, Kriti, and I'm wondering kind of how this is going to land this time and how much impact it's really going to have, given what is happening in Germany, given what is happening in France right now, the spending constraints that we've been talking about, particularly with Paris, proving maybe problematic. If you want to improve competitiveness, do you have to invest? If you want to invest, do you have the money to do so, Kriti? And that French budget, which you've been talking about a great deal, could be really critical here.
And now we're talking about an extension to that French budget. We'll actually see if the EU Commission actually agrees to give them that extension. But this is, of course, the conversation here in Paris. Mario Draghi may have some big ideas. Christian Neuer might have some big ideas as well. How viable is it when there's no money to actually implement?
China, obviously a big factor in all of this. Did you see the data? Once again, the Chinese inflation data really disappointing. China seems to be caught in something of a deflationary trap at the moment. You're certainly seeing a liquidity trap beginning to emerge as well. The data are really grim. And you've got to wonder, can Europe really start to grow enough to invest if China is doing what it's doing right now?
It's a fascinating one as well, because now I'm having deja vu on the conversation of whether what's going on in China actually has an impact on the rest of the world. How many times have we said that China's exporting deflation to the rest of the world, and then yet we saw resilience going in the opposite direction? It feels like everything, all three regions are kind of snapping back into the same story, which is a slowdown on all fronts. To me, though, Guy, I think the question is, how does that read through into Europe? We talk about it through the luxury space. Terry Breton due to make an announcement today as well, I believe after Mario Draghi, on the pain you're seeing in the EV sector. A lot of that a result of China as well.
I tell you what, the luxury space is certainly one you want to watch out for. You're seeing some real casualties coming out of China as a result of that. As you say, the EV space, another one. Europe, two really big drivers from Europe really struggling as to what they're going to do next with that China trade. We're going to discuss all of this throughout the programme. We've got some fantastic guests for you lined up to set your week up, basically. Freya Beamish is going to be joining us very shortly, Chief Economist at TS Lombard, 7:30 UK time. We are going to be talking that China trade. Alicia Garcia Herrero, Chief Economist for Asia Pacific and Natixis CIB, is going to be joining us. At the Open, we've got Jeff Yu. Fantastic to get his take on what is happening with these markets at 8:30 as well. Should we question the consensus? What is the consensus this morning? We're going to ask that question to Rob Arnott, founder and chairman of Research Affiliates. He's going to be joining us, Kriti, at the back end of the show.
A really fascinating one. Look, today is going to be a really interesting day for Europe. It kicks off, of course, those deficit negotiations that you're seeing in France and, of course, in Germany as well. But there's plenty of other things to watch this entire week, in addition to what's happening with Mario Draghi out of Brussels as well. I think this one's interesting. Tech is back in focus, but with a little bit of a twist. Apple launching their iPhone today, the first iPhone with that new generative AI product. We've talked about how they've been late to the game when it comes to the AI story. Is this their solution to that? Just hours after they do, Huawei also launching their trifle launch. How much of that is a snub to Apple? How much of that is in terms of comparing the products head to head? That's going to be a key question in terms of the U.S.-China debate. And speaking of the U.S.-China debate, of course, that's going to be a key feature in the debate between former President Donald Trump and Kamala Harris. That, of course, on Wednesday. Plus plenty of data, industrial, manufacturing data, trade balance, and then, of course, the big hitter, CPI on Wednesday. Does it substantiate some of the weakness that we're seeing in the labor market as well? And then right off the heels of that, you've got the ECB rate decision, the U.S. initial jobless claims, and PPI. Guy, I think it's safe to say there's a lot going on this week, a lot to digest, and I wonder how much of what we see this week speaks this idea of the resilience in the United States and the resilience in Europe just fading even faster.
Yeah, that's the question. It's really the rate of change here. Do we care about the inflation numbers anymore? If we look at what is happening in the commodity space, certainly you could take a signal from that inflation is going to fade fairly fast. Look at what's happening with oil. Look at what's happening with iron ore. But the consumer, Kriti, is absolutely critical. Anna was sending around a story last week talking about how the consumer is basically holding up the periphery in Europe via the tourist trade. If you look at what is happening in the States, the consumer is holding up a lot of what is happening on the spending front. And is that to do with what is happening in the stock market? The spending story is absolutely front and centre here. The rest of the economy looks fairly weak. If the consumer cracks, are we in real trouble here? And then we need to really see the Fed accelerating those rate cuts. Let's talk about that Apple story as well, which I think is fascinating, because that takes us back, Kriti, to the AI story. In many ways, we need a new narrative around AI. We need maybe some concrete examples of how it's going to work and how it's going to be monetized. And I wonder whether Apple is about to provide that.
Well, you know what I love about Apple and as a company and in terms of how we analyze it is that, yes, it's a tech company. Yes, it's an AI story. It's a liquidity story. It's a big kind of stock mover, but it's also a gauge on the consumer to kind of connect your former point as well, because I'm going to do a little bit of deja vu here, Guy. When we were talking about the increase of consumer spending post-pandemic, Apple data was actively tracked by analysts and economists because it's not only a gauge of how much consumers around the world can spend on what at the end of the day is a luxury product, but also what foot traffic looks like in some of these stores. I bring it back to the AI story because their big piece of this tech equation is, yes, you have this fancy new technology and that's great, but it only works, and you're only seeing this acceleration because there's still so much money kind of clinging around in this economy. If there's a slowdown in the broader economy, how much willingness is there to invest in new technology?
Yep, it's a key question. And that consumer strength story just feeds really directly into this. It all comes together, I think, in Apple. What else do you need to know this Monday morning? Let's run through the details. As Moscow steps up its missile and drone barrages against Ukraine, 2 NATO members have reported incidents involving Russian drones over the weekend. Latvia's president said a Russian military drone crashed in the country. Romania's foreign minister urging Russia to abide by international law after a drone violated its airspace. Venezuelan opposition leader Edmundo Gonzalez has been granted political asylum in Spain. Authorities in Venezuela ordered his arrest in the wake of the disputed election back in July. The United States says his, quote, departure is a direct result of the anti-democratic measures by Nicolas Maduro. And Boeing and its largest union say they have reached a deal to potentially avoid a strike at the troubled US aircraft maker. The offer includes a 25% wage increase over 4 years and a commitment to build Boeing's next plane in Seattle. That's obviously probably going to be the narrow body. The breakthrough comes after a marathon bargaining session. But it's too soon, Kriti, to know whether or not actually we will see this deal stick. Certainly, a lot of the indications online post the announcement seem to indicate that not all workers are happy. There's a vote to ratify the deal on the 12th. If that fails, i.e. if Labour decides that it doesn't want this deal that has been negotiated on its behalf, then potentially strikes could start as early as the 13th.
What is the implication of that here, though? I mean, we're seeing these kind of strikes, these labor union talks really across the country. And there's a big political kind of nuance to this as well when we talk about Kamala Harris and Donald Trump. We'll dive into that throughout the week as well. But I'm curious, in terms of the actual manufacturing capability, let's say this deal doesn't work out. Guy, what actually gets hit here?
Well, I think for Boeing, it's really bad news, a company that can't really sort of afford to have this kind of thing happening right now. I think for the manufacturing sector in the United States, there would be huge implications as it ripples down through the supply chain. Boeing, just look at the data in terms of the export numbers, etc., a huge part of this story. And then you think about what it means for inflation. Think about the wage component of what we've just seen in the data coming out Friday. The wage story is not rolling over maybe as quickly as you would have anticipated. And if Labour demands more than that 25% increase and say wants 35, maybe 40%, that has implications for the manufacturing sector. The manufacturing sector in the States is still in quite a lot of difficulty right now, but it just says maybe that we're not quite done with the labour inflation story. Anyway, I think it's going to be certainly one to watch out for, and we'll fold that into all our conversations throughout this morning. We'll fold it certainly into the next one. The race for the White House heating up. Another poll suggesting the election very much too close to call. We're going to discuss that and Donald Trump's 100% tariff threat on countries that shun the dollar. We'll talk about that next. Plus, we're going to dig deeper into the big tech story of the week, Apple launching its next generation iPhone with AI attached. We're going to talk about all of this. We'll digest the payroll number. We'll talk about the implications of that as well. Freya Beamish, chief economist at TS Lombard, is going to be joining us. Join the debate this morning. Tell us some questions that we need to be asking to our guests. IB Plus, BB TV Go is the function. You can get in touch. This is Bloomberg.
Overall, I would say for the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. I don't see red lights flashing.
No red lights flashing. The US Treasury Secretary Janet Yellen speaking to Bloomberg after Friday's jobs report. Joining us now to discuss, Freya Beamish, chief economist at TS Lombard. Freya, the Treasury Secretary seems pretty comfortable with what's happening right now. We're getting a slowdown, but it's not that dramatic. We're probably still in soft landing territory. There are no red lights flashing. The jobs report Friday looked okay. Was it?
I think there's a few red lights flashing, but they're in kind of isolated areas of the economy. Not isolated, but they're in pockets of the economy, whereas the big picture still speaks to the possibility of a soft landing. You know, if we get essentially what markets are pricing in, which is 25 basis points every meeting, and then 50 if something scary happens. I think where we're starting to see a few kind of red lights and indications that the Fed does need to get a move on and deliver those kind of rhythmic cuts is for instance, within construction, if we look at construction jobs compared with permits, the construction jobs look quite overextended in the context of the deterioration in permits and starts. Professional jobs are likely to be a bit weaker given what's happening in markets. So there's kind of pockets there, and obviously manufacturing is the big one that's already coming through as quite weak. And kind of looking at the broader global context of manufacturing, it doesn't look like that's going to turn around anytime soon, looking at some of the leading indicators from China.
Freya, I thought the market reaction was really interesting Friday, particularly to the Chris Waller comments. From the Fed. He was indicating that he's comfortable with 25. He's indicating that it should be kind of slow and steady, the kind of layout that you're suggesting. The problem was, though, the risk assets sold off on the back of that. Do you think consensus is beginning to shift out of kind of soft landing territory into hard landing territory? You said there that maybe the Fed's a bit behind the curve. That seems like a really difficult judgment to make at this point.
Yeah, I think they probably are a little bit behind the curve. ECB and Bank of England are further behind the curve. So it could be that a 50 basis point cut is necessary at some point over the next kind of 6 months or so. But I think where markets are perhaps a little bit ahead of themselves is the extent to which the Fed is going to have to cut to stabilize this economy. There's a few red lights, as I said, maybe not no red lights as Yellen is asserting, but there's a few red lights, particularly looking at the demand side of the economy. Lower income households are sort of running out of money and starting to run into issues, auto loans. These types of things are starting to be more problematic. Again, kind of small businesses that aren't picked up so much by kind of credit spreads. These areas are starting to be a little bit more problematic. But I think overall, this is an economy which doesn't seem to have anything that really needs to be corrected by any kind of prolonged recession. So a soft patch to correct this kind of period of perhaps excessively long tightness from the Fed. But the neutral rate of interest has probably risen from before the pandemic, so not necessarily needing quite as much cutting as markets are expecting. And then perhaps markets, in response to your questions over kind of 50 basis points, yes, maybe markets are looking for that. I think investors tend to kind of run from one side of the boat to the other. I'd actually be more worried about kind of surprising cuts, surprisingly large cuts, in the sense that what we saw in August was partly about kind of reversals of carry trade, and I'm not sure that that's all worked out for the market as well. So surprising markets on the dovish side could work out backfiring as well.
Well, Freya, walk us through kind of in this era where it almost feels like inflation has been ticked off in kind of the Fed's to-do list. How does oil prices feed into all of this? Would a declining oil price, as we've seen, I think we're looking at below 70 on NYMEX crude this morning, is that a tailwind for kind of the economy, the idea that oil prices may not be weighing as an inflationary factor so hard? Or is that another red flag, one that maybe Janet Yellen is missing?
Yeah, I think it's a red flag that demand is perhaps starting to need those cuts, but it also is a very strange labor market that those cuts would be proceeding into. So, as you're suggesting, that would hand back purchasing power to the U.S. consumer, which hasn't cracked yet. And the middle income section of the distribution still seems to have reasonable amounts, in fact, more than they had compared with spending in their bank accounts, as compared with prior to the pandemic. So this is an economy, I think, that is starting to show some cracks because interest rates have been kept high for too long. But once those interest rates come back down again, I think it's an economy that can kind of pick up again. And that pertains to kind of real incomes and kind of declining oil prices and cuts starting to feed through reasonably rapidly.
Well, so Freya, that's the U.S. kind of consumer story, and I fully understand, especially ahead of an election, the value of what people are paying at the pump. But I'm curious how that shows up in other parts of the economy. China, even Japan, where oil import prices were a bit of an overhang. Does this offer the same tailwind to those economies as it might for the U.S.?
It does to some degree. In China, the energy prices are much more regulated. So because they were regulated on the way up, there's less of a kind of a boon as energy prices come back down. From the perspective of the consumers, it's more sort of like the middleman that gets a release of the squeeze on margins in the Chinese case in particular. But China's going to need a lot more than a kind of a fillip from real incomes being boosted by oil prices declining, as we saw with the data. This is an economy that is locked in a deflationary kind of down spiral here.
Fred, just to come back to the issue, the relationship between oil and inflation, do you think, given what is happening with the stickiness in service side inflation, that the ECB, the Fed, etc., will see oil prices as being a huge positive? They come down, that in theory lowers inflation, but in some ways it puts more money back into people's pockets that they could spend maybe on services, and as a result of which that inflation maybe remains even more sticky. How do you think central banks in Europe and the United States will view lower commodity prices?
If I could, I try to avoid being normative, but if I can be normative for just a second, just to make a point here. Before the pandemic, we would have loved this. We would have said this is great. There's the potential for real income, and that's going to drive private consumption. If we weren't all so worried about there being kind of wage inflation spirals in the 70s kind of coming back into view, then this would be actually a really good situation to be in. And I think from a market perspective, going beyond this kind of soft patch that we find ourselves in, which, the leading indicators have been pointing in this direction in a while, but from a market perspective, there should be sectors that benefit from this, that we can kind of look to at least on a medium-term basis as kind of income generated, real income generated private consumption is kind of coming back online after a long period of dormancy. So when I look at wage growth still holding up, I'm not thinking, oh dear, that means that there's going to be a resurgence of inflation. I'm thinking, okay, well, maybe that does mean that inflation is going to be a bit higher, but it also means as long as that kind of higher pressure doesn't leak abroad through kind of currency movements, especially in the case of the US, that maybe CapEx will kind of come back online, and maybe businesses will be thinking both, okay, well, wage growth is there. That means that in the aggregate, that means that there's going to be income to buy my product, and wage growth is there. And so for me as an individual farm, I better do some investment so I can keep my unit labor costs down. And that means productivity comes back online as well. So I'm not worried about it from that perspective.
Excellent. Freya, that was great. Thank you very much indeed. Freya Beamish, Chief Economist at TS Lombard. OK, we're going to go back to that inflation story next. Not quite done with it just yet. China's CPI cooling. We're going to take a look at what the growing deflation risk in the world's second largest economy actually means for the rest of the world, particularly Europe. You've only got to look at what is happening with the luxury sector and the declines that we've seen there to talk about the impact that the Chinese consumer is having in Europe. So we're going to discuss all of that next. This is Bloomberg. Monday morning, futures looking all right. The selling out of Friday may be starting to abate, Kriti. We're 30 minutes away from the opening trade. What are futures looking like right now?
Yeah, green on the screen when it looks like you are seeing in the equity market, perhaps following some of the pain that we saw last week as well. But the entire vibe of this market cross-asset outside of the commodity space seems to be a risk-on kind of sentiment. And you're seeing that in the bond market as well. When you look at the FTSE 100, that's where the outperformance is in the equity story. But in the bond market, where you're already seeing some of the European kind of sovereign bonds trade higher, yields higher by almost 4 basis points and counting. I think it's a really interesting vibe that we're seeing in the stock and the bond market.
Let's talk about one of the impacts that we are certainly seeing rippling through into Europe this morning, Kriti, and that's what's happening with the Chinese inflation data. It's just an indication, once again, maybe of the challenges that Europe faces with one of its biggest markets really struggling. And again, the data cooling. We're basically looking at inflation data that is the weakest in more than 3 years. This is what Goldman Sachs' chief China economist had to say about the pressure that is really piling up on policymakers.
What's noticeable is the government reaction to the weakening data. Both policy meetings are emphasizing they still want to get to close to 5%. And what they're doing, you look at the government bond issuance in the month of August, 1.8 trillion RMB of issuance. That is the single largest monthly issuance ever. Even bigger than June 2022 when we just came out of Shanghai lockdown. So I think we're at the juncture that the organic private demand seems to be weakening more than we would like to see. At the same time, policymakers are getting uncomfortable.
Getting uncomfortable, but not really doing very much thus far. How uncomfortable do they have to be? So we have seen some limited effects to try and get, limited attempts to try and get household spending, but it's really not showing up. Consumer prices have risen less than expected again last month. Alicia Garcia-Herrero, chief economist for Asia Pacific at Natixis CIB, joins us now. Alicia, we haven't seen much of a policy response. Therefore, should we expect really much of an improvement in the data?
Absolutely not. That's the whole point. I mean, having trillions of yuan put in the market as government issuance is not what is needed, because this money does not percolate into the economy. Just to respond to Goldman Sachs' point on this, we need more. We need targeted fiscal measures for the households. That's what we need, and they're not coming. We barely heard some news about additional subsidies to purchase electric vehicles, which stopped in 2023, so we're back to where we were. But, you know, that's not going to drive the economy. And therefore, we need really a welfare state in China, something big, unemployment benefits, pension benefits for the whole population. That's what we need, and there's no fiscal space for that. So watch out. It's just not going to happen.
So if it doesn't happen, what is the impact on the global economy? For the last few years, it felt like we've treated China as being ring-fenced, as being isolated for the global economy. Clearly, that is wrong. Are we starting to see already the chilling effects of this Chinese deflation on the rest of Asia? We're starting seeing an impact here in Europe. How big an effect, how big a ripple are we going to see coming out of China?
It's massive. It's clearly massive for a very simple data point that we all need to remember. China exports 1/3 of intermediate goods in the world. So, you know, if these goods, this is basically producer prices today at minus 1.8%. That's a massive rippling effect, deflationary factors, and of course, huge competition for European companies and others. European companies in particular, because they are hitting China's upscaling is hitting exactly the sectors where Europe was doing well in global markets. So it is a massive shock for the European economy. We can't forget this.
Alicia, when we talk about exporting goods, there's a line over the weekend that came out from the Trump administration that we're looking at potentially 100% of tariffs on the economies that shun the dollar. China has been actively moving out of the dollar, de-dollarizing, still buying U.S. treasuries, but ultimately de-dollarizing. Walk us through kind of the implications on the China front in terms of what that could actually look like. Do you see that in your expertise incentivizing more buying of the dollar? What do you think?
Well, there's a couple of things happening here. Yeah, Trump has been talking down the dollar, maybe, you know, as a way to reduce the trade deficit in the future. But I'm not sure that's a good idea, because there is de-dollarization forces being pushed by China in the global south. We know that in and out. This is BRICS plus, new currency. Don't think it will happen, but it doesn't help the dollar. And therefore, I think while those pressures might not be real, in fact, if you look at dollar use of the dollar internationally, you know, trade settlements, you name it, is still very strong. It is clear that a massive move from Trump could really create that circumstance where people start shine away from the dollar. I don't think it can come from China because its currency is just not international enough. But Trump could make it, so I hope he doesn't. And this is why I think China is getting ready for that by, pushing this de-dollarization from beyond political reasons, obviously.
Well, Alicia, one of the things that we're seeing in the markets as well, alongside substantial weakness in the dollar, of course, coming off those bets on the Federal Reserve, is right alongside it, substantial weakness in oil as well. Now, geopolitics are a big part of that, but so is consumer demand out of the two largest economies in the world. And I'm curious how much of that is actually helpful for China's economy, one that's already struggling, and I'd argue Japan as well. How much of the oil story removes an overhang in the APAC region?
Well, I really like your point on oil weakness because it does point to the direction of the two largest economies in the world. I think China for much longer, this structural deceleration, which is continuing, and then the US coming up with the same kind of tone, maybe not structural, but cyclical. So, clearly not good news for oil, but in a way, good news for Japan, for China, for importing economies. Not so much good news for some countries in ASEAN. Of course, Malaysia is a good example. So, we're going to see a little bit of a hit back, if I may say so, out of this weak oil, which I doubt will be derailed structurally. We may see some hype because of tensions in the Middle East and so on. But I think with these weak economies out there, largest in the world, hard to see how this is going to change anytime soon.
Alicia, let's talk a little bit about Mario Draghi. Mario Draghi, former ECB boss, is going to unveil his competitiveness report for Europe a little bit later on today. What advice would you give him? What advice would you give Europe about how it needs to best compete with China? Is it through tariffs? Is it through something else? How does Europe compete with China that is seeing deflation at the moment and is going to try and export some of that deflation to the rest of the world?
Great point. With my second hat at Bruegel, we've been given a lot of advice to Mario Draghi for his report. So I can only say that, first, I welcome the report. I think it's extremely important for Europe. Second, I think no matter the fact that I do agree we need to take some precautionary measures tariff-wise, because a lot of China's competitiveness, which is not all, but some of it, of course, is based on humongous industrial policy measures that needs to be tackled. Europe cannot be the only market out there for European goods. We import 55% of European EVs, Europe alone, the European Union. So, you can tell it's clearly the most open market if you look at the figures. So, but that's not enough. So we Europeans need to understand that defense is not an answer. It's just a temporary answer. We need to attack meaning certainly not anything but compete on a better term, meaning more innovation. Single market has to be strengthened. All of this is in there. So, there's no news from my side, but I just want to highlight the importance of Europe not falling behind in critical technologies, quantum, AI, semis. The best we are doing so far in this three is quantum technology, and a lot is already being wiped out by purchases from the rest of the world, to be frank, and Europe not being able to scale up those new technologies, patents, innovation. So, we need to make sure we have the capital market union, etc., to drive up the commercialization of our innovation. For sure, that's a must.
Well, Lissy, to follow up on Guy's point there, we talked about Mario Draghi. Terry Breton also due to make a statement today on the EV story in particular. There isn't a ton of optimism on what everyone is expecting him to say. I'm curious what the pain points in Europe are now moving forward. Every time we get these headlines coming out of China, they're looking at parts of the European markets. Luxury, of course, is one that certainly gets hit. Pork, dairy is another. And you do actively see that in the markets. But I'm curious what that next step is. What, from your point of view, would signal even further tensions and even further pain points in the European economy?
Well, if we're talking here about China's retaliation to the EU's countervailing duties on electric vehicles, I think we need to realize two things very important. First, Europe has been the country on earth, literally, that has increased countervailing duties the least. They're not even outright tariffs. You can look at India. You can look at so many emerging economies, not only the US or Canada. So, I just fail to understand why Europe would have to pay the price for everybody else. That's number one. And Europeans should realize that falling into the trap of reacting to retaliation won't solve the problem. And now, how much can China retaliate? I would advise European leaders to look at two cases, Australia and Canada, even South Korea for that matter, in the mid-2000s, where actually China did not manage to retaliate enough to change these countries' positions. And in fact, South Korea in particular started the de-risking that we Europeans think we have invented. And this was after Lotte's exit from China, then Samsung moved to Vietnam quite cautiously, or better, quite silently, but in a way, eventually forcefully. So, that's what Europe should do.
Okay. There's a nice little prelude for the Draghi report coming up a little bit later. Alicia, thank you very much indeed. Alicia Garcia-Herrero, Chief Economist for Asia Pacific, joining us from Natixis CIB. We're not done with China just yet. Luxury stocks, remember, have taken a near $240 billion hit since March. Potentially there seems to be more to come. Chinese growth, we've just been discussing it, the major risk here. We're going to talk about that sector, plus all the other stocks you need to be watching this Monday morning. That conversation is next. This is Bloomberg.
This report is better than in July.
We think the economy is definitely slowing.
It's a little bit weaker on margin.
This economy is not slowing down in the way that markets are anticipating.
When we think about September, we think 25 basis points is quite reasonable.
It's hard to say, which way they go. I think, the market is pushing for 50.
25 is the right number, given that literally everything in this report was better than in July.
I don't think this report is definitive on the 25 versus 50.
Is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
The Fed, they need to adjust policy back to more normal levels, and the question is just how quick do they want to do that?
How quick do they want to do that? That's the key question. Some of our guests reacting to the payroll number that we saw Friday. In some ways, the bigger event Friday was not the payroll, it was Waller. Chris Waller comes out, Fed's Chris Waller comes out and basically seems to imply that he's comfortable with 25, takes 50 off the table. Risk assets really don't like that, which I find a little perplexing. So let's kick this around with our Markets Live executive editor, Mark Cudmore. Mark, the payroll number looks all right. Waller takes 50 off the table. Risk assets don't like it. That seems to tell me that risk assets now believe that 50 is required to stabilise the situation, i.e. we're maybe tiptoeing into hard landing territory. Am I reading that right?
I think that's a fair kind of straight line interpolation of the price action on Friday, but I'm not sure I'd want to read too much into that immediate short-term trading on a post non-farm payrolls Friday, right before the blackout period, before this kind of binary Fed. I think there are a lot of other factors at play here. I think it does look like the Fed is going to probably do 25 basis points. What is interesting is that we're not completely sure of that going into the blackout period. Normally we have quite a high degree of clarity. We should do after CPI this week, but it looks like 25 basis points. And there is a kind of negativity, at least by Friday's close, that, hey, this isn't good for stocks either way. If it's 50, well, the Fed is panicking, and then that means they're behind the curve and there's recession coming. If they only do 25, well, it's not enough easing coming for the market. So there's definitely a negative mood going into the weekend. That was the theme of last week. I expect that to temper a bit this week and people to realise, the US economy is slowing, but it's not doing too bad at all.
Well, Mark, what would put more credibility behind a 50 basis point cut? What does the Fed need to see for that to get solidified?
Well, The first thing that could happen is we get a surprisingly, miss in CPIs on the low side there, saying that it's kind of inflation is rushing back towards target. It's important to remember that we've been above target for several years now in inflation. And yes, the disinflationary trend still seems to be in track. It still seems to be good, but we're not there yet. And there are some sticky components. So I also don't see us to have the kind of CPI volatility that would give a big miss this week. So I'm not expecting that to come into play. The only other aspect is that we are suddenly careening toward a financial crisis or some kind of recession. And again, I don't see that kind of come through in the next kind of week or so before the Fed, unless markets significantly correct much further from here. So basically, I just don't see the conditions for 50 basis points arriving in the next week.
Oil's up. Brent's trading 71.79 this morning, but it was down very hard last week. Mark, should that signal frighten us?
Yeah, I think so. But it is more about global growth and Chinese growth in particular. I think that it seems amazing, but pessimism around China is still intensifying. We've seen a lot of brokers give up on bullish calls recently. There's still disappointment in the market that China's economic story is not getting a little bit more of a positive spin. I think that's the main story around commodities here. You see it in metals as well. Iron ore is probably the most extreme case. So there's a global growth concern which is concentrated around China. It's abetted by those recession concerns around the US. I think they're a little bit overblown overall.
Great stuff, Mark. Thank you very much indeed. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you want to find Mark's views, you want to find the team's views. You really do want to find the team's views. They're fantastic. Read this stuff. It's great. MLIV Go on your Bloomberg terminal. Let's carry on the conversation around China, certainly dominating the stock story in Europe this Monday morning. Joe Easton, over to you.
Morning, guys. We're going to be keeping an eye on the luxury sector today. Remember, this was one of the worst performing sectors in the broader decline that we saw last week. We saw big losses in the likes of LVMH, Kering, Hermes and Richemont, some gains or declines of almost 10% in a lot of those stocks last week. Now, analysts actually rushing today to put out more info on what they think is going to happen in the sector. There's a good note out from RBC this morning calling for declines in earnings estimates, saying they continue to remain cautious on luxury in general as consensus expectations remain elevated, i.e. analyst expectations that need to come down, partly due to those issues in terms of the Chinese demand. And we've also got some rating changes today as well. Kering, the owner of Gucci, cut sector perform at RBC and also underway over at Barclays. So they actually recommend selling that stock alongside Burberry as well, which goes underway over at Barclays today. Hermes, meanwhile, a price target cut down at Morgan Stanley. So a lot of analysts are trying to update us on this sector this morning. Then we've also got some M&A news, this one over in chemicals. OCI in Amsterdam offloading a unit for around $2 billion. Now they are selling their methanol unit to Methanex over in Canada, and it is the second big sale that they've announced in recent months. They recently announced the sale of their ammonia business, which saw this one actually outperform the sector recently. We can see that on the orange line here. So potentially this $2 billion sale for OCI could be a bit of a positive this morning. Then we're looking at autos, a pretty stark warning out of Renault at the weekend. The CEO saying that the sector faces billions of euros in fines as it's not keeping up with the European Union's targets on EV sales, missing the EU's EV sales targets by some margin, according to the CEO there. We've got Renault, actually been a bit of an outperformer on that one recently, has seen a bit of a decline over the past couple of weeks. But take a look at the analyst ratings, an impressive one on this one, 19 buys, not a single sell on Renault today. But those comments around potential fines related to EVs, potentially negative. Keep an eye on that one in Paris today.
All right, Bloomberg Equities reporter Joe Easton walking us through some of these stocks to watch at the opening trade. We're just minutes away. But, Guy, I think it's really interesting that we're talking here about the auto space because there's a couple of things to factor in. Of course, so much of the non-farm payrolls weakness came from the manufacturing sector in the state. So I thought that was really interesting at the time when U.S. politics are really dominated by what's happening in the Rust Belt. Kamala Harris, Donald Trump, both trying to really court that audience, meeting with the likes of the Teamsters Union, for example, which can be a real game changer in those labor talks. On the flip side, in Europe, we're getting Terry Breton talking about a report as well, which also aren't going to signify a lot of strength in that sector.
Europe's got a major problem with this space. It has forced the automakers to switch to EV. as we've just been hearing from Joe, there is a threat of fines coming down the road as a result of that. The consumer, though, is increasingly less interested. Certainly the early adopters have all bought their EVs and they're driving around in them. The rest of the population seems less keen. The hybrid solution increasingly looks like a popular one, but that doesn't deliver on the fines front. You've got countries withdrawing subsidies. So it's a really difficult, I think Europe faces a really difficult challenge. And then, of course, Kriti, you layer on top the Chinese threat as well. This is a very difficult situation for Europe's automakers to deal with. What is Draghi going to say about this?
I was just about to say, we already know that Draghi's going to talk about the defense ramp up as well, but so much of that is cushioned on extra money. But it's also the very argument that is lacking in the States and arguably in Europe as well when it comes to lack of infrastructure to support, to your point, that EV transition that everyone was really excited about a couple years ago. This feels like a really great combination of both fiscal and kind of arguably competitive mishaps and missteps from a lot of these European governments.
Yeah. Are they going to really be prepared to find their automakers for not making these targets? I don't know. It's a huge challenge. And if there isn't the green infrastructure grid there to feed the cars, the new EVs, can we really argue that we're making a significant impact here as well? All of that, obviously, a huge challenge that we need to digest and think about when it comes to the European equity story. Manufacturing struggling, but now luxury struggling as well. The Chinese data, difficult. But after last week's sell-off, it looks like European equity markets are going to see something of a stabilising bounce this morning. Doesn't look that convincing, does it? We've got a lot to think about this week. We'll talk about the opening trade next. This is Bloomberg. Monday the 9th, couple of minutes to go before European equities start trading. To be honest, European equities largely priced in the move that we saw stateside Friday. The US market kind of dribbled into the close on Friday, not really doing very much. The price action came earlier on in the session, which meant that we could deal with it over here in Europe. Now, subsequent to that, we've seen futures ticking a little bit higher, haven't we, Kriti? And that means probably we're going to see a little bit of stabilisation maybe here in Europe this morning.
Yeah, we absolutely are. Green on the screen when you look at those European futures. And in major outperformance, by the way, in the UK. I'm looking at a FTSE 100 that's higher by 0.8% when you look at the futures price action. But the Eurostoxx 50 right on just healed higher by, we'll call 0.5% if we can, 51 basis points. This is a big deal. We are seeing a little bit of a rebound from last week. Remember, last 2 weeks we've been lower on the index, so that's going to be something we keep an eye on. From a micro standpoint, though, Guy, a couple of stocks to keep an eye on as well. When you're talking about the China story, that read-through on the weak data that we're getting out there, luxury is very much going to be in focus, as is, of course, the auto space. This is fascinating as we talk then about what kind of fines, as Joe was just telling us in the last hour about, actually come down, not to mention plenty of the conversation happening in Brussels as well. But the one catching my attention as well is going to be in some of the Swiss insurers. There is a claim out here from Swiss Re saying that the litigation costs are increasing in the States and therefore claims for it as well. They think that trend is going to show up in the Swiss insurers as well and potentially boost the stock this morning.
What's interesting is that we've seen 52-week high after 52-week high for some of those insurance stocks over the last few weeks. OK, here we go. It is time for the opening trade, Monday the 9th. We're expecting European equity markets to bounce a little bit, but after such a torrid week last week, maybe that should be expected. Similar story over in the United States. So here we go. Time for the opening trade. Let's take a look at what we're seeing this Monday morning. We are anticipating a positive picture to emerge, and right out of the gate, the FTSE 100 is on the front foot. We're expecting, as Kriti says, maybe some outperformance to come through from the London market, which is interesting given what we're seeing in some of the commodity stocks at the moment, given the weakness we're seeing in iron ore, given the weakness we're seeing in oil. But oil coming back a little bit this morning, maybe that ripples back into the FTSE 100. Elsewhere, keep an eye on what's happening with the luxury sector. The story out of China is not of consumer strength, and that in some ways should again deliver a bad message coming through for those luxury stocks, particularly found in France. So the CAC 40 is only up by 0.3%. Other markets look like they're outperforming a little bit. Though I have to say, Kriti, the margin looks fairly marginal this morning. We're not seeing a huge divergence amongst these European stocks. What are we seeing below the surface?
Well, below the surface, the breadth is what stands out to me, Guy. We're looking at 94 stocks in the FTSE 100 higher this morning. The others down by a very, very small margin when you look at the moves higher. And to your point, it is that commodity outperformance, which is really diverging from what you're seeing in the underlying kind of macro space as well. We've been talking about weakness in the commodities. It is not showing up in the likes of Shell, for example, this morning, or even BP, Glencore, Rio. These are your top performers, your top index contributors to the upside this morning. We should talk about ASML as well. Higher by about 3%. So not only do you have a tech trade in your favor, you also have a commodities trade as well. At least that's what's going on in the FTSE 100. We're still waiting for all the kind of numbers to shake out in the broader stock 600 as well. But there, a lot of the weakness seems to be showing up in utilities, which I thought is interesting. But of course, the heavyweights seem to be on our side this morning, or at least on the side of the bulls for the broader indexes.
Okay, let's talk about some of the movers. Let's talk about some of the stocks that we're watching. We can show them on the screen in front of you. As you can see, SML Holdings is bouncing back. But it's interesting that the mining stocks, Kriti, as you were mentioning, maybe doing a little bit better. Rio is up this morning, but Novo's up, Schneider's up. The AI trade appears to be on the front foot a little bit more. So miners and tech seem to be doing the heavy lifting this morning. A little weakness coming through in maybe some of those European banks. UBS, BNP Paribas, a little softer this morning in terms of the trade that we are watching. All of this obviously needs to be seen in the context of what we got Friday, the US payroll number, the market reaction to the payroll number, the market reaction as well to the Chris Waller comments, maybe signaling that 25 is the right reaction for the Fed off that data. We spoke to many people on Friday about these numbers. One you certainly wanted to have listened to is Bill Dudley, Bloomberg opinion now, but former New York Fed. Let's take a listen to what he had to say.
Officials have basically said policy should be neutral. The risks to the labor market side are equal to the risks on the inflation side, and they're a long way from neutral. But I don't think they're going to do 50. I think that a gradual approach is what they're going to pursue.
Okay, let's carry on the conversation with another voice. Jeff Yu, Senior EMEA Market Strategist from BNY, joining me around the table this morning. 25 the right call?
25 is the right call, I think. If we look at the numbers, the breakdown, we're ready to change that to 50 had the unemployment rate been higher, subject to the usual participation issues, then yes. But markets are not willing to price that out yet. If you look at the curve out to year end.
Why did the market seem to signal Friday that 50 was what was required? Risk assets sold off when Waller sort of turns around and goes, as you have said, that 25 is the right call. Are we tiptoeing into hard landing territory? Is the consensus still soft landing?
I think the consensus is not willing to rule out a hard landing. So it depends if you're glass half full, glass half empty. That kind of an issue right now. You just can't rule anything out. We've had the gyrations in August, so to speak. I don't think people want to be caught out by that again. Hence, in terms of pricing, just in terms of insurance, you don't want to rule that out. But let data do the talking.
Jeff, it's Kriti. I'm curious about how you position for the commodity sector right now. I think the big theme this morning has been this very weak data out of the U.S., a slowdown in the U.S. consumer as well, in the U.S. economy, not to a recessionary point, but a slowdown nonetheless. I'm curious if commodities are still the place to be, given that they were such a crucial hedge in the last couple of years.
I wouldn't take those hedges off, actually. So this is where we may go against the recession view or even a landing view, a soft landing view, because right now, if you look at the Chinese data, especially overnight, look at the PPI and CPI, can we rule out a big push for growth in China in Q4? Now, if there's going to be any push, I prefer to see it on the consumer side, and that seems to be where the narrative is heading towards. But if that is going to be an impulse just for Q4, even on a tactical level, you can't, let's just say, afford to be all-out short commodities yet either. Given where the inflation situation is, we still need to be careful. If inflation is neutral, you don't want to take away that neutrality yet. So don't go, all-out underweight on commodities, even though that seems to be where market wants to head to as well.
Jeff, it sounds like you're saying there is a risk of inflation taking back higher somewhere in the world. I'm curious, is that a risk the market should be pricing in?
I think the markets are not totally pricing that out. If I look at our flow data, for example, where are some of the most long currencies? They are the high-yielding ones. A lot of LATAM commodity currencies, for example, they are seeing outflows, but outflows from a relatively long position. So I think the flow versus the stock and the fact that the stock of, let's just say, these inflation hedges still quite high. Look at gold prices, for example. That just tells us, markets are not willing to fully discount the risk of inflation being stubborn. I wouldn't say inflation surging ahead again in the same way as 2022, 2023. But do you want to like price in a recessionary, a hard landing narrative in commodities? Absolutely not either.
If China delivers the stimulus that maybe you're thinking it might, does gold sell off? China's been a big buyer of gold as a hedge against what is happening in the economy. Do you think gold sells off if we get a Chinese stimulus story?
I don't think it sells off. I'm willing, as much as I'm still relatively sceptical of the price action, willing to concede that that gold view, that asset allocation view for gold and alternatives, so to speak, I think that's here to stay. So these correlations have broken away. Now, we half expected gold to, well, more than half expected gold to sell off when real rates in the dollar and elsewhere, they were going very high, but it didn't. So that has to be an asset reallocation sort of story driven by the central banks. I think that's here to stay as well.
To what extent is a China devaluation story part of the solution to its current economic malaise?
So we'd be very careful with the word devaluation here because 1%, 2% is a one-off. That's considered a large move by CNY standards. But, that's just, part of the course, for most EM names. I do think, however, a weaker CNY must be part of the narrative. They're in deflation right now. You look at the PPI numbers, so you can't have a stronger real effective exchange rate as part of that narrative. And I think, given how the guidance we've seen through the fixings and the like, I think the PBOC acknowledges that.
Is that a reason to continue holding gold? If you're Chinese, is that risk meaning that you actually want to continue to hold on to your gold story?
I think not necessarily gold, but to continue to be overweight, let's just say real assets, ex-real estate, for example. But overall, stronger currency. Now that especially the yen has strengthened, I think that actually gives way for Asian FX in general to actually be a bit more flexible.
Jeff, what do you do with the dollar right now?
It depends on against what. So we're still willing to look at dollar yen lower. So October hike by the BOJ, for example, I think that should be the market's base case. And even the leading candidates, for the LDP leadership election, they're not averse to further normalisation as well. Euro dollar, I do not know what it's doing up here. So I've given up on my parity call for the whole year. I think 105, however, still a viable target heading into year end. So not just euro dollar, what's Eurozone stocks doing up here? And given the awful, awful data that we've seen, maybe politics in France, that's where you are right now, to buy some time. We're not seeing strong outflows, in the fixed income market and the sovereign bond market yet, but it's just hideous mispricing, I think, and let's see what the ECB says. Probably nothing this week on that note, but I think that's where the bulk of the adjustment needs to happen. So I think dollar holds up very well against euro, but again, I've been wrong on that all year.
Well, sometimes the contrarians take it all at the end of the day, but I'm curious how that shows up in terms of the election play. I mean, the market is still positioned long dollar. You're seeing these kind of iterations change because of Fed pricing, but in terms of the election, we're 2 months away. How do you position?
So on a structural level, if we want to look at a dollar discount, for example, or a US discount, so to speak, we still think it probably is maybe a bit more in the bond space because there's not much of a fiscal consolidation narrative in the US. And to be fair, nowhere right now, apart from New Zealand, perhaps, in developed markets. But are we talking about the dollar moving away as a reserve currency? Absolutely not, right? And if anything, some of the policies we're seeing right now, especially strong fiscal, that supports real effective exchange rate. Happy to continue playing that against euro dollar.
Can I just come back to the ECB for a moment? Is the ECB looking at the rearview mirror, i.e. sticky inflation, or is it looking through the windshield at weak growth coming towards it? And where do you think it is in terms of kind of looking up and kind of trying to understand what the priority should be?
Well, I just want to look at it in broad mandate terms. They need to look at growth. And the answer is probably not relative to the Fed, right? So, yes, it is going to be sticky inflation.
But their mandate's the rearview mirror.
Well, so everything's in hindsight, and then they can move aggressively, right? But just based on the rhetoric that we've seen right now, and Schnabel did mention right after the negative CPI print that we had, for August. So granted, it was headline-driven rather than core-driven, but where that inflation momentum was very high. So until services inflation comes off, I don't think the core hawkish element of the ECB is willing to react. But at the same time, I don't think services inflation does come off, because of the public spending, driven aspect of it. But at what point in the rearview mirror do you say, oh, actually, German industry, given the news we've had over the last week, perhaps needs some help? Granted, that's not the ECB's mandate. Absolutely, we need the governments and corporations to actually push forward. But some support is needed.
Jeff, a final question to you on the wage data as well. We paid so much attention to it over in the States. Is that something we're missing in the European narrative?
So I think if you look at the general narrative in Europe, it's what kind of wages are we looking at? So looking at the PMI reports, looking at the contraction, the losses in jobs within the high value added components. If the wage data is showing sticky wages and sticky inflation in low productivity jobs, then are we willing to accept stagflation, that narrative within the Eurozone? So, and I think the answer is no, we shouldn't accept that. Of course, again, that's up to the governments rather than the ECB. But just resolutely sticking to one aspect of the labour market, I think that's just being a bit too dogmatic about things, and you're missing the bigger picture.
Jeff, always a pleasure.
Thanks
so much indeed for dropping by. Jeff Yu, Senior EMEA Market Strategist, joining us from BNY. Let's take a look at the core 6 this morning. What are we seeing in terms of the heavyweights here in Europe? And as you can see, we're actually caught something of a bid this morning, particularly in the chip space. It is bouncing back. ASML is up quite nicely. There is some strength in the luxury space. It comes from Ferrari, but look at LVMH. Weakness there. Joe's been flagging the luxury space all morning. Let's get back to him with some single stocks to watch.
So as you say, Guy, really standing out as one of the sectors that can't quite catch a break at the moment. The luxury stocks, most of these heading lower once again. LVMH down 0.4%, but bigger losses in the likes of Kering, also Burberry as well. Bear in mind, these stocks did fall around 10% last week. There are analyst downgrades on both of those stocks in terms of Kering and Burberry, both going to sell or underweight over at Barclays this morning. Hermes also getting a bit of a price target cut over at Morgan Stanley. All these concerns around earnings estimates around China hitting that sector further today. One stock that is going the other way, though, is OCI. We flagged this one earlier. This is the Dutch chemicals company offloading that unit for around $2 billion to a Canadian company. It is their methanol business. Second big sale for them in the past couple of months, up 1.8% at the moment. And then in London, the best performing stock we've got today is actually in the gambling space. We've got an unexpected trading update today out of Entain. Game on is the pun that the producers slipped in there, so appreciate that one. But that one is up around 5%. A lot of this coming from the US. They've got this partnership with MGM over in the US on American football, baseball, all of those sports. And that is boosting the company at the moment, up 5%, a decent gain for Entain this morning. In terms of miners, though, this one a little bit surprising. We've got iron ore back below $90 now, but nonetheless we're seeing gains, as Kriti was mentioning earlier, across the London mining stocks. Anglo, Glencore, Rio and Antofagasta all gaining around 1% or more at the moment. A bit of a heavy sell-off last week, so it is a bit of a rebound in terms of that sector. Then some interesting analyst ratings to bring you today. Adidas, now this one is downgraded over at Barclays. Now Barclays has a separate note out on sporting goods saying that this is also going to be a weak sector. A lot of that due to the US, also China as well, similar to luxury but more in the sporting space. We come down to equal weight on Adidas, down 2.9%. And finally, a big decliner is Ubisoft, the games company, the company that runs the Call of Duty gaming online. That one down 4.7%. Cantor Fitzgerald, a long-term buyer of the stock, no longer recommend buying, and that is a bit of a surprise for the market today. We're down 4.6%. Ubisoft declining following that Cantor Fitzgerald downgrade.
Joe, great stuff. Thank you very much indeed. Joe Easton taking us through some of the single stocks we need to be watching this Monday morning. Kriti, the big picture, though, this morning, though, feels like one of concern. That the economy is slowing down. Maybe it's not slowing down that fast, but we've spoken to a number of guests already talking about the risks that Europe faces. Jeff Yu was just talking about it. Some of our earlier guests, Fred Beamish, etc., were talking about how Europe is really going to struggle, particularly with what's going on in China. You're in Paris at this IPEM event. I'm sure you've had a lot of conversations already with some of the people we're going to be talking to. Are they worried? Is this an event that is going to be glass half full or glass half empty?
Glass half full, it seems. And I think that's the kind of a surprising aspect because, to your point, we talk about this wall of worry on both sides of the Atlantic. And then yet, when you look at it from a positioning perspective, so many people have kind of piled in and allocated into private equity right now. That's the event that I'm going to tomorrow, where, of course, we're going to speak to the creme de la creme of the industry. But there's so much money in this kind of search for yield really held up in the private space. The question now is, how do you deploy it into the public markets? And to do that, you have to have the capital markets actually open up. We're starting to see a little bit more loosening in Europe than we're seeing in the States. We're seeing the leveraged loan market warm up as well, but it's still not 100% there. And for me, my main question is going to be, how long do we have all these funds wrapped up in the private space and not deployed in the public one?
Yeah, I think it's going to be a really interesting conversation. Really looking forward to some of the great guests that you're going to be talking to tomorrow. It's really, really interesting. And part of that narrative is going to be around what Draghi's going to be talking about as well. Kind of, if Europe is going to step up and deliver a more competitive approach, how does private equity fold into that? There's this whole idea that we need to see public and private money crowding in together. We're going to talk next about what his report is going to tell us about the future of Europe and its competitiveness picture. We get this long-awaited report. Is it already, though, too late? I think that is something that maybe some in Brussels are already fearing, that the political landscape has shifted significantly already. Anyway, all of that is to be discussed next. This is Bloomberg.
We have an economy that doesn't grow in Europe, contrary to the US. In the last 2 years, the European economy grew by less than 1%, while the US economy expanded close to 5%. This is a completely different picture. And inflation in Europe came down very fast, actually faster than it went up.
Mario Centeno, ECB Governing Council member, speaking at Jackson Hole, talking about Europe's dismal growth, certainly relative to the United States. Mario Draghi, set to deliver his long-awaited report on European competitiveness a little bit later on today. The former ECB boss expected to sound the alarm over the risk of the EU's economic decline. I think we've probably all been aware of that for quite some time. Really, what we're looking for here is the solution to that problem. Jamie Rush from Bloomberg Economics joins us now. We know about where we are. We know about where we should be going. The question is, what is he going to say about how we get there? What are we expecting?
Well, he's going to have a long list, right? But I mean, let's just think about the scale of the problem, though. I mean, you said that we've known for a while that the EU's been in decline. Well, 20 years ago, when André Sapir published a report of the same sort of title, in 2003, his conclusion was that Europe is in a rut. And it's been in a rut for the next 2 decades. So we already know the problem. There's an 18% gap relative to GDP relative to the US that's emerged in that time. If that continues, the EU's place in the world is going to be dramatically reduced, right? It's not going to be a global power. And that's going to have big implications. So I think we all know the scale of the problem. Solutions generally involve money, right?
Yep. And we've got so much of that.
Yeah, tons of it's just coming. But I mean, this is the real rub. So yes, we need big strategic investments in energy, in telecoms, in finance, whatever is required to try and lift the potential output of the Eurozone. The money to finance that, though, well, there is no fiscal space. We all know that. And the last chance, perhaps, for the EU to be able to drive those common challenges forwards was common debt. And that is basically dead in the water now that Macron has suffered. It's been dramatically weakened in France, and he was the big cheerleader for common debt issuance. So I think when we get to the end of today, we're going to have the same sort of questions we had before, which is how we're going to finance all this stuff.
Well, Jamie, that is a crucial question. You mentioned France, but Germany as well is really struggling with this exact idea. And I'm curious, though, if that might change or if there's pockets of this 900 million euro investment that Draghi's expected to kind of encourage, if there's pockets of it that are actually viable.
I think when you think about the politics of the common debt, what's changed is that Germany was always resistant, but it appeared perhaps 6 months, a year ago, to be softening its position slightly. But I think since Macron has kind of lost power in France in any meaningful way, anyway, his kind of ability to drive forward the French agenda has been very limited. And so I think that one of the first casualties of that election loss, European and parliamentary election loss, was common debt. So I think that there really is that very limited scope there, very limited appetite. It's not just Germany as well. There are other countries which are deeply resistant to that sort of strategy. So it comes down to, if you're not going to spend your way out of this problem, then you're going to have to make sorts of politically unpopular structural reforms, which have always been difficult for the EU to achieve. So I think that's where we are. We have the same sorts of problems, the same sort of political constraints. Some of those have actually got even worse And so it's going to be a tough next Parliament for the EU.
Is the environment going to get worse? Let's say Trump's elected in the United States. Does it get worse? Even if Harris is elected in the United States, does it get worse? If China wants to dig itself out of the hole that it's in, presumably it needs to become more competitive globally as well and export some of its solution to the rest of the world. How much worse could it get for Europe for this?
Well, I mean, if you think about it, Europe has the problems that it's had for the past few decades. They're still there. Now it has new problems. It has a competitiveness problem because China is subsidising a lot of its production. The US is doing the same. They're throwing resources at it. The EU can't do it, hasn't done it in the same way. And so, yeah, we have this new front, and Europe as well has also got to decide where it's going to sit in the geopolitical order. And it's much more exposed to China than the US is, so it's a much more difficult decision to get on board with what Trump might want, for example, in terms of relations with China. It's not going to be easy, so it's going to have to navigate that very difficult route on the geopolitics side, as well as tackling all the problems that it has that are legacy issues.
Jamie, is that the trick to this all? To just basically, if France and Germany had more fiscal bandwidth, the way that at least is being shown up in, say, the outperformance of the periphery of Europe, is that the trick to kind of fixing all of Europe's problem right now? Or is this still kind of late cycle dynamics that we're seeing with a recessionary hangover? Is that how to think about it?
Yeah, but I think there's an element of truth there. I think the reality is that whatever problems Europe has, they're going to take time to fix. We're not going to see it over the course of one economic cycle. We're going to see it over the course of several economic cycles, and it's about building the resilience into public spending plans, for example, so that when shocks hit, the first thing you do is not cut public investment, for example. These sorts of structural changes are going to be what's needed to preserve European spending and to keep us kind of resilient to those sorts of cyclical ups and downs.
All right, Jamie Rush from Bloomberg Economics giving us the breakdown of kind of a lot of the news that we're going to get out of Brussels as well with the Mario Draghi report, as well as Thierry Breton, making crucial comments on the EV space as well. Of course, this is the conversation right here in Paris as well as we talk about what Michel Barnier, can actually do in this role. He's an expert negotiator. He's had all that Brexit experience. Can he apply it to his own parliament that only seems more and more divided by the day? And whether or not that extension from Brussels is actually granted, does it make a difference? We're going to dive into the market file of all of that. Coming up on the program, we're going to ask Rob Arnott from Research Affiliates where the market consensus might actually be wrong. If we're talking about 25 or 50 or even a re-acceleration of inflation, what does that look like and where do you position? That conversation next. This is Bloomberg.
30 minutes into the trade this Monday, the 9th. Let's talk about where we are. As you can see, a little bit of a bounce back. This in no way compensates for the sell-off that we saw last week, particularly towards the back end of last week in terms of risk assets. But at least we're stabilising. I think you can probably say that as being a positive story this morning. Travel and leisure, technology, financial services, industrials are where we're seeing the gains this morning coming through. Real estate and utilities, the kind of more bond proxy end of the market, is reacting negatively, but not down by that much. 0.2% seems to be the narrative there. A little bit of outperformance maybe coming through from some of the mining stocks as well, but not that great. Certainly we were anticipating maybe from the early trade a little bit more from that. So we've seen a sell-off. We saw it last week, one of the worst weeks we've seen, certainly on either side of the Atlantic. The question is this going to be something that turns into a little bit more? Is this an opportunity that you want to be jumping onto and thinking about going forward? Well, our next guest says there will be great buying opportunities in the next couple of years. This, though, probably isn't one of them. Rob Arnott, founder and chairman of Research Affiliates, joining us around the table this morning in London. Great to see you, Rob, on this side of the... I'm good. What about the markets? How are you feeling about the markets? Are they good?
Well, I love finding asymmetries. Yep. And what we have in the landscape of the market is a view that forget hard landing, forget soft landing. There's no need for any landing because things will be just fine. Yep. Well, you've got Purchasing Managers Index in its worst quartile ever. You've got inventories in their highest quartile ever. You've got yield curve inversion, worst decile ever. You've got rate of change of cost of capital over the last 3 years, worst quartile ever. Each of these is a powerful indicator of potential slowdown. And so I love asymmetries, as I said at the beginning. The asymmetry, if you've got a robust economy, for the robust economy to become a stupendous economy, not very likely. For it to become a softer economy or a recession, not unlikely. And so while the base case of the market, continued robust growth, is not off the table, certainly very possible, the asymmetry is on the downside.
Do you think Friday we started to see some of that being reflected in asset prices? I thought Friday's session was fascinating. The payroll number was okay.
It wasn't bad.
Great, wasn't bad. Let's just park that for the moment. Then we start to see Fed officials coming out and talking about the idea that maybe 50 is not necessary, which feels commensurate with maybe the data. But the market risk assets react quite negatively to that. My signal from that is that maybe portfolio managers are beginning to get concerned about that hard landing, about that downside risk. Do you think the consensus is beginning to shift towards that downside risk?
I think the consensus is shifting. One of the issues is I think the Fed, in general, central bankers all over the world, have an inaccurate view of how much influence they can have. Basically, we keep hearing long and variable lags for monetary policy. Isn't that another way of saying, well, we don't really understand what the influence is, but we're going to play the game anyway? And one of the best examples in my mind is the Australia, which has been called the lucky country because it went for 30 years without a recession. Well, 25 of those 30 years, it had a yield curve that was always positive in real terms. And always positively sloping. They kept the short rate anchored fairly close to the long rate, typically 0.5% or 1% below the long rate. And it seems to me that that's the Fed's basic job. They claim to be data dependent. The one data point that they pay no attention to is the long bond, which is set by the market, by bid and ask of millions of investors. And if that's saying that deferring consumption for 30 years ought to be worth something south of 4%, then that tells us that the natural short rate would be somewhere around 3%. The Fed held rates at zero for far too long and then overshot on the upside. They're constantly playing the game of trying to micromanage an economy when the tangible evidence is that they don't have that much influence.
Rob, talk to us a little bit about whether that applies on the front end of the curve as well. The comment you made about the 30-year, and I ask this because we're looking at an environment when we're talking about record amount of money sitting in money market funds. And I'm curious if that movement from the market then applies to the real economy, in your view, faster than the Fed's transmission mechanism. How does that work?
Fed's transmission mechanism really affects short rates and rates that are linked to short rates, for instance, mortgages. It doesn't have that much impact on the aggregate macroeconomy, and what impact it has happens with a long and variable lag, which tacitly means they're always going to be behind the curve. When they react to economic weakness by cutting rates, they're cutting them too late. When they react to hints of inflation, where the hints of inflation are becoming stronger, they're reacting too late. Getting ahead of the curve is hard, but having a steady hand at the tiller is not that hard. I'm not sure why central bankers don't choose to have a steady hand at the tiller. So,
Rob, are you saying that perhaps this bond market is not seeing as much momentum as maybe it should? If you're talking about 3% on the front end of the curve, we still have a ways to go to get to that point. What's your bond call?
Oh, we sure do. My bond call, firstly, I'm not an expert on short-term movements in markets. I really have a long-term focus. My long-term view is that the natural yield for long bonds is about 1.5% above the rate of inflation, and the natural rate for short rates is about 0.5% to 1%. That said, the market's pricing in a very benign economic outlook, And the asymmetries would suggest that a slowdown in the coming year is relatively high odds, and that a recession is not off the table and a bear market is not off the table. I would view buying opportunities as being a ways off, but I would also say that the upcoming election creates some short-term opportunities, because we have a paper coming out shortly that shows that the market doesn't care much who wins the election. That when you have a contentious election, the markets, both sides, are terrified that the other side will win. And if both sides are terrified the other side will win, they go risk off. As the election approaches, in the closing days of the election and after the election's over, one side breathes a sigh of relief and comes back into the market. So what we find is a pretty regular pattern that in contentious elections, stocks struggle in the run-up to the election, and about a week before the election happens, begins to take off. It's about an average of a 6%, 7% move in a single month in contentious elections. So that's one thing that's interesting to play.
Short in, long out. What does a buying opportunity look like to you then?
Buying opportunities are situations where investors are in a panic, when investors are terrified, when nobody wants to...
Give me a sense of the scale. How do I spot that? Because we've had, beginning of August, markets sell off. VIX spikes aggressively. Clearly, there is some nervousness in the market. Last week, equity markets sell off. We've seen one of the worst weeks in really quite some time. What kind of order of magnitude are you thinking that a sell-off is going to look like?
That's a sell-off, not even a correction. A very serious bear market creates panic, and panic is the wonderful buying opportunity. We're nowhere near that anywhere in the world.
When we're talking about anywhere in the world, though, there are places that are undervalued, and when you look at it from a equity perspective or even a bond market perspective as well, a lot of folks are making that argument on Europe. Your take on that regional divergence?
I think Europe is an attractive place to invest. It's out of favor. It's unloved. Its economy is struggling. The opportunity for the broad European stock market to do well is a very real opportunity. You buy where people don't want to buy.
Yeah. Are they buying not for... your opening line there I thought was brilliant. It's unloved. The economy is not doing very well. It's unloved because the economy is not doing well, surely.
Correct. But where are you more likely to see an economic rebound off of a robust economy or off of a soft economy?
Well,
the soft economy you can recover.
Isn't the danger that the economy gets softer?
There's always that risk. Like I said, I love asymmetries, and if the market is pricing in a particular view, then the asymmetries, Europe starts to catch up.
China? China looks really weak.
China, I would view as moderately attractive now. Now, 3-4 years ago, I would have said absolutely not. But President Xi has shown his true colors by every time he says, please invest in our country, then he begins to do things to make it very painful to do business in the country. So, in my view, he's an unreconstructed Maoist and can't change his stripes.
There does seem to be some contradictions in what he says. Rob, it's been great to catch up. Thank you for joining us here on this side of the Atlantic. We look forward to seeing you again very soon. Rob Arnott, founder and chairman of Research Affiliates. Thank you very much.
Thank you.
Indeed. Coming up, Apple preparing to unveil its first AI-focused phone. Can the iPhone 16 launch and the next super cycle? Is it an AI super cycle? If we need the next catalyst on the AI front, does it come from Apple? It's part of our big take today. We'll do it next. This is Bloomberg.
For the U.S., the kinds of metrics that we would monitor that would summarize risks, whether it's asset valuations or the degree of leverage, things look good. There are not, I don't see red lights flashing. While there are risks, it really has been amazing to be able to get inflation down as meaningfully as we have. This is what most people would call a soft landing. Certainly may go back there. I would welcome a visit by my Chinese counterpart.
Janet Yellen there, U.S. Treasury Secretary, speaking to Bloomberg on the sidelines of the Texas Tribune Festival in Austin. Now, it's a really fascinating conversation. We're talking then about what the red flags look like. Politics is, of course, keeping one eye on it as well. Republican presidential nominee Donald Trump leading Democratic contender Kamala Harris by 1 percentage point in a poll taken late last week. It's just the latest sign that the race is still too close to call, even less than 2 months out. Let's get more on this. Bloomberg's Kevin Whitelaw joins us this morning. Now, technically, he's the Brussels bureau chief, but this is a man who is an expert in the machinations of Washington, D.C. Kevin, your take on whether that momentum behind Kamala Harris has peaked?
So, I mean, I think it's way too early to tell. She is still leading in a lot of the other recent polls that have been taken. So I think everyone's trying to figure out whether this latest poll is just an outlier or maybe the sign of a slight subtle shift in the overall race. So I think you always have to be very careful reading too much into any single poll, particularly a national level poll. This is going to come down to a couple of swing states. And the polling in those swing states is always a little harder to parse because in the end, it's going to come down to who actually shows up, who's most motivated to show up on Election Day. And I think we still have, believe it or not, just under 2 months left in the race. And, that still can shift a little bit. One of the key inflection points we'll see is the upcoming debate between the two of them.
The headline over the weekend, Kevin, which really caught my eye, and I wonder whether it's going to come up in the upcoming debate, is Trump's attitude towards tariffs. And he's now kind of drawing a line between his tariff policy and the dollar. Don't use the dollar, you get 100% tariffs. Honestly, how seriously do I need to take this?
Well, I think you always have to take those kinds of policy descriptions from him seriously, but not necessarily literally. So he does love the idea of tariffs. He views them as something that isn't really a tax on Americans, even though obviously consumers end up picking up the tab in most of these cases. But he does want to see a tougher trade policy, and that's something that sort of resonates with a lot of his group. So I think you'd see something. Would it be exactly 100%? How would it work? I think that is going to take a long time to actually sort out. We don't really have any details. It's not like there's, sort of policy papers on his website that sort of spell all of that out. But I do think that it does show you that if he does win, whether it's Europe, whether it's China, it's going to be a much more aggressive trade policy than we've seen.
Well, I wonder if it's something that comes up in his debate showdown with Kamala Harris. I think that's tomorrow night in the States. And I'm curious how big of that might actually change the momentum either in his favor or against him. Is this the game-changing moment pre-election?
I mean, the last one certainly was in ways none of us possibly imagined. I think this particular debate is super important. I think one of the interesting elements that you saw, and it showed up in the New York Times poll, is that people are still looking for more information on Kamala Harris. And so this is both an opportunity for her to continue to introduce herself to more Americans and to sell herself. But obviously, there's a lot of risk for her in terms of making sure that she can actually stand up to Trump and his attacks. So, Trump has his own moments of potential peril in this too. He has a history sometimes of bristling when he's confronted by strong women. So I do think that it is a moment where both candidates will go in with a game plan, and it's really unclear whether either of them are going to be able to stick to it.
Kevin, final quick question. You're in Brussels, so I just want to ask you this. Is Brussels agog with anticipation for the Draghi report? Are we all really excited about what is going to happen? How much of this is really going to be a game changer?
Well, I do think that the Draghi report is an important moment in Brussels where the Commission and the European Union more largely are going to be trying to grapple with what is becoming an increasingly clear and stark problem for them, that European industry is having more and more trouble competing with U.S. and Chinese companies, particularly when it comes to just productivity and just overall investment and startups, saddled by high energy prices. And so you are seeing an effort to try to jumpstart this conversation to make some really serious changes, both in sort of the overall investment level in some of these industries, but also with just some additional agility to begin to sort of set itself up better for the future.
Kevin, great stuff. Thanks very much indeed. It's going to be an interesting week for Europe and the United States. Kevin Whitelaw joining us on both. I think the Draghi report has a number of issues that I think are really going to be important for Europe. Europe is much more exposed to the China trade. Some US companies are, though, directly exposed to that trade as well, and Apple is one. So it's going to be really interesting to see what we get from Apple. It could also be affected by the tariff trade if Trump were to become president. The global tech giant is a little later on today going to be unveiling its iPhone 16. In theory, this is the first AI-focused smartphone. How focused it's going to be, I think, remains a big question. Apple, the focus of our big take today, Bloomberg's big take, looks at some of the importance around this company and how it's risen to become the world's most valuable business. Matt Bloxham, senior technology analyst at Bloomberg Intelligence, sitting alongside me to talk about all of this. We've been waiting for something new for Apple to justify its status. Is the iPhone 16 with AI attached going to be that moment?
I don't think it's going to be the moment, but it may be the start of a moment. Right. Obviously, we had a kind of precursor to that with the announcement of Apple Intelligence back in June. I think since then we've heard that actually some of these features are going to come later and later than expected. So I think what we're going to see later today is them very much put Apple Intelligence at the heart of what this device is. But actually, you know, it's going to be... You're just going to have to wait a few months at least until this stuff kind of comes out. But I think that is going to give some clarity because there's been lots and lots of talk about which features that you can see today, which ones are coming when. So I think we should get at least some clarity about this today. So I think around that, the device itself isn't really going to look very different from the iPhone 15. There's going to be a couple of extra buttons. We'll have to see whether the pricing stays the same or they try to kind of get a little bit more out of people from it. But it's 50% of Apple's revenue, so it's massively important to them, and it's really the kind of anchor for all the service revenue, which is another 25% of their business. So it's a really kind of critical device for them to get right.
Matt, just hours after Apple unveils their first kind of Gen AI product, or AI features, as you point out, you have Huawei doing something very, very similar. How much of that is a threat? How much of that was by design? Your thoughts?
Yeah, I don't really see it as that much of a threat because you've got two camps. You've got the Android world, which Huawei's in, and then you've got the Apple ecosystem. And if you look at the kind of market share between the two, it's kind of fairly stable. And if anything, in some markets, the Apple ecosystem is kind of gaining a bit of inroads into the Android ecosystem. So, you don't see, you're not going to see a whole bunch of Apple users suddenly switch to a Huawei device on the back of their latest update.
So Europe is going to have to wait for the AI stuff because of the regulation over here. Yeah. Can Apple deliver AI to China? Given the importance of the Chinese market, are we starting to see the AI marketplace being segregated? You've got the United States, you've got Europe, you've got China.
Potentially, yes. I mean, that's a massive question. Obviously, Europe's a big question about how they're going to be able to deliver it here too. And there's all sorts of other kind of regulations and legislation and antitrust issues going on too. So, I think the AI environment does create lots more questions about how accessible some of these markets are to, non-Chinese
Does that reduce the value of Apple? If you can't sell... If the next iteration is to sell AI products, AI smartphones, etc., is Apple's upside limited by its capacity if it can't deliver it to two of its key markets?
I mean, obviously, China is a key market, but there are lots of other key markets for Apple, and obviously India has been a market that for many years people have been looking at as a big opportunity for Apple, and we've seen them, change things about the production facilities to kind of serve that market more. So it certainly puts more pressure on Apple to find ways to kind of plug that gap if we do get one, but I don't think in itself it's a big worry.
Matt, great to see you. Thanks as ever for stopping by. Matt Bloxham joining us from Bloomberg Intelligence. That's going to be one of the big events still going to be watching. That launch is going to be one that's going to start our week, but it's a really big week. You've got an EU tech ruling coming up. That regulatory story is going to be absolutely fascinating. But this week is going to be dominated by a number of different events. You've got the Draghi event coming up a little bit later today. You've got this US presidential debate, which we're going to be watching very, very carefully Tuesday into Wednesday. We've got an ECB meeting coming up. You've got industrial data. So you've got industrial manufacturing data we're going to be watching out of the UK. Keep an eye on the wage data out of the UK as well today. I think that's going to be really, really important. The ECB, I think, is going to be fascinating. What kind of language are we going to get from Draghi? I think is going to... Sorry, from... I'm getting behind myself. I should be getting ahead of myself. What are we going to get from Lagarde in terms of what she talks about? Is she worried about the future or is she worried about the past? Is she worried about growth or is she worried about inflation? And we've got UMISH data coming out on Friday. Kriti, you've got a big day coming up as well tomorrow. Talk us through who you're going to be talking to and what the tone of those conversations is going to be.
Well, the tone from a macro perspective seems to be very doom and gloom, but the tone in private equity is the exact opposite. And the argument here is that private equity operates at a little bit of a lag. So you can think about it two ways. You could think about it as the red on the screen in the public markets may not show up just yet, or it's simply delayed. And this is interesting because you're seeing a record amount of money in these markets, a record amount that really hasn't been deployed in the public markets because they're stuck in the private one. So we're going to talk to the top folks over at Apollo, KKR, among many, many others in Europe about when those capital market activities, when those flows come back into the public markets and whether this is one area where Europe is actually ahead of the game. So I'm really excited about those conversations.
Kriti in Paris. That sounds like a show, doesn't it? Maybe somebody's thought of that one beforehand.
I'm ready for Kriti in Tahiti. I think that's the one I'm going to try to pitch.
That sounds also quite excellent as well. Yeah, maybe that could be the next... We'll all go on that field trip, I think. What we got coming up next, because Kriti and I are pretty much done, Francine's going to take over. She's going to be speaking to Jeff Curry, Chief Strategy Officer for Energy Pathways at Carlyle. Always interesting to see what he has to say. Big down week last week for energy prices. A little bit of a bounce here this morning. In terms of what we're watching this morning from an equity point of view, as I say, a little bit of a bounce back. Does this feel risk on? Doesn't quite feel like risk on yet, given the context of what we saw last week. Anyway, Francine has got a great lineup on her show. I will hand you over to her. Really interesting to hear what Jeff Curry has to say about the energy space. That's next. This is Bloomberg.